Question 1. Which of the following statements regarding the tax status of municipal bond interest is most accurate for a bond issued in a state where the investor resides? A. Interest is always exempt from federal, state, and local taxes. B. Interest is exempt from federal tax, and potentially state and local taxes if the bond is issued by the investor's state or a political subdivision of that state. C. Interest is subject to federal tax, but exempt from state and local taxes. D. Interest is generally taxable at all levels unless it is a general obligation bond. Answer: B. Interest is exempt from federal tax, and potentially state and local taxes if the bond is issued by the investor's state or a political subdivision of that state. The interest earned on municipal bonds is generally exempt from federal income tax. Additionally, it may be exempt from state and local income taxes if the bondholder resides in the state or municipality that issued the bond, a concept often referred to as the triple tax exemption. For example, a resident of New York who buys a bond issued by New York City would typically receive interest-free from federal, state, and local taxes. Always remember that while federal tax exemption is standard, the state and local tax exemption depends on residency and the issuer's location. Question 2. A municipal bond's official statement would not typically include which of the following? A. The bond's ratings. B. The underwriter's compensation. C. The legal opinion. D. Projections of future stock market performance. Answer: D. Projections of future stock market performance. The official statement is the primary disclosure document for new municipal bond issues, providing detailed information essential for investors to make informed decisions. It typically includes the bond's credit ratings, details about the issuer, the legal opinion confirming the bond's validity and tax status, and the underwriter's compensation. However, it does not include projections of future stock market performance, as municipal bonds are debt instruments and their performance is unrelated to stock market movements. Think of the official statement as a prospectus for municipal bonds, focusing solely on the bond's specifics and the issuer's financial health. Question 3. What is the primary difference between a general obligation, GO, bond and a revenue bond? A. GO bonds are typically riskier than revenue bonds. B. GO bonds are backed by the full faith and credit of the issuing municipality, while revenue bonds are backed by specific project revenues. C. Revenue bonds are always subject to federal income tax, while GO bonds are tax-exempt. D. GO bonds are issued by state governments, and revenue bonds are issued by local governments. Answer: B. GO bonds are backed by the full faith and credit of the issuing municipality, while revenue bonds are backed by specific project revenues. The key distinction between these two types of municipal bonds lies in their source of repayment and security. General obligation, GO, bonds are secured by the full faith and credit of the issuer, meaning they are repaid from the general taxing power of the municipality, often including ad valorem, property, taxes. In contrast, revenue bonds are backed by the revenues generated from a specific project or facility, such as a toll road, airport, or water system. Understanding this fundamental difference is crucial as it impacts the bond's risk profile and how it is analyzed. Question 4. An investor subject to the Alternative Minimum Tax, AMT, should be cautious about investing in which type of municipal bond? A. General obligation bonds used for public purposes. B. Revenue bonds used for public purposes. C. Private purpose municipal bonds. D. Public Housing Authority bonds. Answer: C. Private purpose municipal bonds. Certain municipal bonds, specifically those classified as private purpose municipal bonds, may be subject to the Alternative Minimum Tax, AMT. These are bonds where a significant portion of the proceeds benefit a private entity, even though they are issued by a municipality. While most municipal bond interest is tax-exempt, the interest on these specific bonds can be considered a tax preference item for AMT calculations. Therefore, an investor liable for AMT should carefully review the bond's offering documents to determine if it is an AMT bond. Question 5. The Municipal Securities Rulemaking Board, MSRB, has authority over which of the following? A. Issuers of municipal bonds. B. Financial advisors to municipal bond issuers. C. All registered broker-dealers involved in municipal securities. D. The federal tax exemption status of municipal bond interest. Answer: C. All registered broker-dealers involved in municipal securities. The MSRB is a self-regulatory organization, SRO, that creates rules for municipal securities broker-dealers and municipal advisors. While it establishes rules that govern the conduct of firms and individuals involved in the municipal securities market, it does not regulate the municipal issuers themselves or directly determine the tax status of the bonds. Its primary role is to protect investors and the public interest by developing rules for fair practice and conduct in the municipal bond market. Think of the MSRB as the FINRA for municipal bonds. Question 6. All of the following are typically sources of revenue for a municipal general obligation, GO, bond except. A. Ad valorem taxes. B. Sales taxes. C. State shared revenues. D. User fees from a specific project. Answer: D. User fees from a specific project. General obligation, GO, bonds are repaid from the general taxing power of the issuing municipality, drawing from a variety of broad-based revenues. These typically include ad valorem, property, taxes, sales taxes, and state shared revenues. However, user fees from a specific project, such as tolls from a bridge or water utility charges, are the revenue source used to repay revenue bonds, not GO bonds. This distinction highlights the security differences between the two types of municipal bonds. Question 7. A municipal bond with a triple tax exemption is one where the interest is exempt from A. Federal, state, and local income taxes. B. Federal income tax, but subject to state and local taxes. C. Capital gains tax, but subject to income tax. D. All taxes for institutional investors only. Answer: A. Federal, state, and local income taxes. A municipal bond offers triple tax exemption when the interest income earned on the bond is exempt from federal income tax, state income tax, and local income tax. This exemption typically applies when an investor purchases a municipal bond issued by a municipality within their own state and sometimes within their own city. For example, a resident of Chicago buying a bond issued by the city of Chicago would likely enjoy this benefit. This tax advantage is a significant feature that attracts many investors to municipal bonds. Question 8. A bond resolution or trust indenture for a municipal bond typically specifies the A. Names of the broker-dealers selling the bond. B. Issuer's current stock price. C. Covenants and protective clauses for the bondholders. D. Underwriter's profit margin. Answer: C. Covenants and protective clauses for the bondholders. The bond resolution or trust indenture is a legal document that outlines the terms and conditions of a municipal bond issue. It details the issuer's obligations and covenants, promises, to the bondholders, as well as any protective clauses designed to safeguard the investor's interests. This could include provisions for the flow of funds, rate covenants for revenue bonds, or limitations on issuing additional debt. These documents are crucial for understanding the specific rights and protections afforded to bondholders. Question 9. An investor purchasing a new issue municipal bond would find the most comprehensive information about the bond's terms, risks, and financial condition of the issuer in the A. Prospectus. B. Official statement. C. Confirmation statement. D. Syndicate letter. Answer: B. Official statement. For new issues of municipal bonds, the official statement serves as the primary disclosure document, similar to a prospectus for corporate securities. It provides detailed and comprehensive information about the bond issue, including the purpose of the bond, the security and source of repayment, the issuer's financial condition, and any relevant risks. Investors should always review the official statement thoroughly before making an investment decision. Remember, for municipal bonds, it's the official statement you'll be looking for. Question 10. Which of the following best describes the credit analysis of a municipal revenue bond? A. It focuses on the issuer's general tax base and overlapping debt. B. It primarily examines the ability of the specific project to generate sufficient revenues. C. It evaluates the national economic outlook and interest rate trends. D. It depends on the prevailing stock market conditions. Answer: B. It primarily examines the ability of the specific project to generate sufficient revenues. When analyzing the creditworthiness of a municipal revenue bond, the primary focus is on the specific project or enterprise that will generate the revenues used to repay the bond. This involves assessing factors like the project's historical earnings, future demand for its services, and the operational efficiency of the facility, example a toll road's traffic volume, a water utilities user base. This differs significantly from GO bonds, which are analyzed based on the issuer's overall tax base and financial health. Question 11. What is the main purpose of bond insurance for a municipal bond? A. To protect the investor against market price fluctuations. B. To guarantee the timely payment of principal and interest if the issuer defaults. C. To ensure the bond's interest remains tax-exempt. D. To increase the bond's yield for investors. Answer: B. To guarantee the timely payment of principal and interest if the issuer defaults. Bond insurance is purchased by a municipal issuer to enhance the credit quality of its bonds. An insurance company, typically with a high credit rating, guarantees the timely payment of both principal and interest to bondholders in the event that the issuer defaults. This reduces the risk for investors and often allows the issuer to borrow at a lower interest rate. While it doesn't prevent market fluctuations or guarantee tax-exempt status, it provides a crucial layer of security against default. Question 12. A municipal bond is callable. This means the issuer: A. Must redeem the bond at par value at maturity. B. Has the right to redeem the bond prior to its stated maturity date. C. Can convert the bond into common stock of the municipality. D. Is obligated to offer the bond to existing bondholders before the public. Answer: B. Has the right to redeem the bond prior to its stated maturity date. A callable municipal bond gives the issuer the option to redeem the bond before its scheduled maturity date, typically at a specified call price, often par value or slightly above. Issuers usually exercise this right when interest rates have fallen, allowing them to refinance their debt at a lower cost. This feature is a benefit to the issuer but presents a reinvestment risk to the bondholder, as their bond may be called when interest rates are less favorable. Question 13. Which of the following would be considered overlapping debt in the analysis of a general obligation, GO, bond? A. Debt issued by a state-level authority for a specific project. B. The municipality's share of debt from a school district or water district that overlaps its geographical area. C. Debt incurred by the municipality's general fund for operational expenses. D. Debt issued by a corporation located within the municipality. Answer: B. The municipality's share of debt from a school district or water district that overlaps its geographical area. Overlapping debt refers to the debt of one political entity that is also the responsibility of another political entity that occupies the same geographical area. For example, a city's residents are responsible for both the city's GO debt and their pro rata share of the county's GO debt, or a school district's debt that covers the same area. When analyzing a municipality's overall debt burden for a GO bond, overlapping debt is a critical factor because it represents an additional financial burden on the same taxpayers. Question 14. An investment in municipal bonds would be most suitable for an investor seeking A. High capital appreciation potential. B. Taxable income and aggressive growth. C. Preservation of capital and tax-exempt income. D. Immediate liquidity and short-term trading profits. Answer: C. Preservation of capital and tax-exempt income. Municipal bonds are generally considered suitable for investors who prioritize preservation of capital and desire a steady stream of income that is often exempt from federal, and sometimes state and local, income taxes. They are typically lower-risk investments compared to equities and are not bought for aggressive growth or high capital appreciation. Their tax advantages make them particularly attractive to investors in higher tax brackets looking to maximize after-tax returns. Question 15. The yield to maturity, YTM, of a municipal bond reflects A. Only the annual interest payment. B. The return if the bond is held until its first call date. C. The total return an investor can expect if the bond is held until maturity, considering both interest payments and any capital gains or losses. D. The coupon rate divided by the bond's current market price. Answer: C. The total return an investor can expect if the bond is held until maturity, considering both interest payments and any capital gains or losses. Yield to maturity, YTM, is the most comprehensive measure of a bond's return, representing the total return an investor anticipates receiving if they hold the bond until it matures. It takes into account not only the bond's annual interest payments but also any difference between the bond's current market price and its par value at maturity, i.e., capital gains or losses. Understanding YTM helps investors compare different bonds based on their potential total return over their lifespan. Question 16. What is the purpose of a legal opinion in a municipal bond offering? A. To rate the creditworthiness of the municipal issuer. B. To certify the bond's tax-exempt status and legal validity. C. To determine the bond's offering price to the public. D. To provide a guarantee of payment to bondholders. Answer: B. To certify the bond's tax-exempt status and legal validity. A legal opinion, typically rendered by a bond counsel, is an essential component of a municipal bond offering. It certifies that the bond issue is legally valid, properly authorized, and that the interest income is exempt from federal taxation, and often state and local taxes, if applicable. This opinion provides crucial assurance to investors regarding the legal soundness and tax status of their investment. Without a favorable legal opinion, the marketability of a municipal bond would be severely hindered. Question 17. Which of the following is true regarding industrial development revenue bonds, IDRs? A. They are always exempt from federal, state, and local taxes. B. They are backed by the full faith and credit of the issuing municipality. C. The interest may be federally taxable if a significant portion of the bond's proceeds benefits a private corporation. D. They are a type of general obligation bond. Answer: C. The interest may be federally taxable if a significant portion of the bond's proceeds benefits a private corporation. Industrial Development Revenue Bonds, IDRs, also known as Industrial Revenue Bonds, IRBs, are a specific type of municipal revenue bond where the proceeds are used to finance a facility for a private corporation. While issued by a municipality, the repayment is secured by the corporation's lease payments or other revenues, not the municipality's general tax base. Because they primarily benefit a private entity, the interest income on IDRs may be subject to federal income tax, and sometimes even the alternative minimum tax, AMT, depending on the specific circumstances and usage of the proceeds. This is an important exception to the general tax-exempt rule for municipal bonds. Question 18. In the secondary market for municipal bonds, trades are typically negotiated. What does this mean? A. Prices are set by the MSRB, and dealers must adhere to them. B. Investors place bids, and the lowest bid wins the bond. C. prices are determined through direct discussions and agreement between buyers and sellers, or their brokers. D. All municipal bonds are traded on an exchange, like the NYSE. Answer: C. Prices are determined through direct discussions and agreement between buyers and sellers, or their brokers. The municipal bond secondary market is primarily an over-the-counter, OTC, market, meaning trades are negotiated rather than conducted on a centralized exchange with open auctions. Prices are established through direct discussions between broker-dealers representing buyers and sellers, reflecting the often less liquid nature of individual municipal bond issues compared to widely traded stocks. This contrasts with equity markets where prices are often determined by supply and demand on an exchange. Question 19. A net direct debt calculation for a municipality would exclude which of the following? A. General obligation debt of the municipality. B. Debt supported by specific revenues. C. Overlapping debt from other taxing authorities. D. Sinking fund accumulations to repay debt. Answer: D. Sinking fund accumulations to repay debt. Net direct debt refers to the municipality's total general obligation, GO, debt, minus any self-supporting debt, like revenue bonds, and any sinking fund accumulations or other funds set aside specifically for debt repayment. The calculation aims to show the true burden of the municipality's GO debt on its taxpayers. Sinking fund accumulations are specifically excluded because they represent funds already earmarked to reduce the outstanding debt. Question 20. What is the primary risk associated with a municipal bond that has a refunding call feature? A. The bond's interest payments might cease without warning. B. The issuer might redeem the bond early if interest rates decline, forcing the investor to reinvest at a lower yield. C. The bond's tax-exempt status could be revoked. D. The bond might be downgraded by a rating agency. Answer: B. The issuer might redeem the bond early if interest rates decline, forcing the investor to reinvest at a lower yield. Refunding is a common reason for municipal bond issuers to exercise a call provision, particularly when interest rates have fallen significantly. By refunding, the issuer essentially issues new bonds at a lower interest rate to pay off existing higher interest bonds prematurely. While beneficial for the issuer, this creates reinvestment risk for the bondholder, who receives their principal back early and must then reinvest it in a lower interest rate environment. This is a key risk to consider for callable bonds. Question 21. When a municipal bond is quoted as bid at 5.00, asked at 4.90, this quotation implies: A. The bond's coupon rate is 5%. B. The bond's current yield is 4.9%. C. The dealer is willing to buy at a 5% yield and sell at a 4.9% yield. D. The dealer is willing to buy at a 4.9% yield and sell at a 5% yield. Answer: C. The dealer is willing to buy at a 5% yield and sell at a 4.9% yield. In the municipal bond market, quotes are often given in terms of yield rather than price, especially for larger blocks. A bid at 5.00, asked at 4.90 means the dealer is willing to buy the bond from an investor at a yield of 5%, which would be a lower price, and sell the bond to an investor at a yield of 4.9%, which would be a higher price. Remember, bond prices and yields move inversely. A lower yield means a higher price for the bond. This reflects the dealer's profit margin. Question 22. Which of the following best describes the term debt limit for a municipal bond issuer? A. The maximum amount of debt a municipality is allowed to issue based on state law or its charter. B. The maximum interest rate a municipal bond can pay. C. The highest credit rating a municipal bond can achieve. D. The total outstanding debt of a municipality, including all types of bonds. Answer: A. The maximum amount of debt a municipality is allowed to issue based on state law or its charter. A debt limit is a statutory or constitutional restriction imposed on the amount of general obligation debt that a municipality can issue. These limits are typically set as a percentage of the municipality's assessed property value and are designed to protect taxpayers from excessive debt burdens. When analyzing a GO bond, investors look at the issuer's current debt level in relation to its debt limit to gauge its remaining borrowing capacity. Question 23. A special assessment bond is a type of municipal bond used to finance A. General capital improvements for the entire municipality. B. Projects that benefit a specific geographic area, with repayment from taxes or fees levied only on properties in that area. C. Projects for a private entity, with repayment from that entity's revenues. D. Daily operational expenses of the municipality. Answer: B. Projects that benefit a specific geographic area, with repayment from taxes or fees levied only on properties in that area. Special assessment bonds are a type of municipal bond issued to fund public improvements, such as sidewalks, sewers, or streetlights, that specifically benefit a defined group of property owners within a limited geographic area. The repayment of these bonds comes from a special tax or assessment levied only on the properties that directly benefit from the improvement, rather than from the general tax revenues of the entire municipality. This makes them distinct from general obligation bonds. Question 24. A municipal bond with a nominal yield of 4% and a current yield of 4.5% is trading A. At a premium. B. At a discount. C. At par. D. In the secondary market only. Answer: B. At a discount. The nominal yield is the bond's fixed coupon rate, while the current yield is the annual interest payment divided by the bond's current market price. If the current yield, 4.5%, is higher than the nominal yield, 4%, it indicates that the bond is trading at a discount, below par. This is because for an investor to earn a higher yield than the coupon rate, they must have purchased the bond at a price lower than its par value. Conversely, if current yield were lower than nominal yield, the bond would be trading at a premium. Question 25. Which of the following is not typically a factor considered when evaluating the credit risk of a general obligation, GO, bond? A. The municipality's population trends and economic stability. B. The issuer's existing debt burden and debt service coverage. C. The specific project's ability to generate user fees. D. The municipality's tax base and ability to raise taxes. Answer: C. The specific project's ability to generate user fees. When evaluating the credit risk of a general obligation, GO, bond, the analysis focuses on the issuer's overall financial health and its ability to repay debt using its general taxing power. This includes factors such as population trends, economic stability, the existing debt burden, and the breadth and stability of the tax base. The specific project's ability to generate user fees is a key consideration for revenue bonds, as their repayment relies solely on those fees, not on the issuer's general taxing authority.